The Greens want the federal government to scale back negative gearing and capital gains tax concessions in exchange for support on one of the government's key housing policies.
This came out of nowhere. Just as we wrapping up the first 2 months of the year, here came trouble. If this bill passes, the entire Australian property investment framework could undergo significant changes. Negative gearing and capital gain tax concessions may be abolished. For many property investors, these tax incentives are the last lifeline in the current high-interest environment and a crucial means for high-income groups to reduce taxes after implementing the third phase of tax cuts. It wouldn't be an exaggeration to say that they are among the core concepts of Australian property investment. How these two tax measures affect investment returns, how they influence house prices, why the government wants to scrap them, whether it's feasible to implement such changes, who would be most affected by this change, and who would not be affected. We'll address all these questions in this video. If you own an investment property in Australia, or even if you're considering buying one, you must watch this video. I'm Alex, welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it.
Labor's refusal to phase out billions of dollars in property investor tax concessions to property investors like yourself is denying millions of renters the chance to buy a home.
Anthony Albanese currently owns 3 properties, bristling at the Greens' suggestion it's people like him unfairly benefiting from a generous tax system.
On February the 5th this year, the Labor Party submitted a bill to Parliament to implement the Help to Buy scheme. The Help to Buy scheme involves the government providing 40% of the funds for purchasing a home, with the buyer contributing a minimum of 2%, and the remainder being financed by a bank loan. The aim is to assist financially struggling young people in buying homes. To pass the bill in the Senate, the Labor Party needs the support of either the opposition, which is the Labor Party, or the crossbenchers. Coincidentally, the Greens, combined with the Labor Party, can form a majority in the Senate, allowing any bill to be passed. Thus, the Greens saw an opportunity to leverage. If the Labor Party wants to implement the Help to Buy scheme, fine, the Greens can support it. But in exchange, the Labor Party must also support the Greens' policy to abolish negative gearing and capital gains tax concessions. The Greens, focused initially on the climate issues, have become the spokesman for those who can't afford to buy or rent homes. What exactly are negative gearing and capital gain tax concessions? For ordinary Australians buying an investment property, note this does not apply to primary residences, only investment properties. Almost all expenses generated by the property, including property management, land tax, and a whole lot more, can be deducted from the income generated by the property, which is the rental income. If your income exceeds your expenses, resulting in a profit, then you pay tax on the profit portion at the same rate as your personal income tax. This means combining your net income from the investment property with your personal income for taxation purposes. For example, if your personal income for the year is $100,000, you would pay $24,967 in personal income tax. If your investment property generates a net income of $5,000, your total income for the year would be $105,000, resulting in a personal income tax of $26,692. This means that from the $5,000 earned from the investment property, $1,725 would need to be paid in taxes at 34.5%. In the same example, if the property incurs a loss of $5,000 for the year, your personal income would be considered $95,000, leading to a tax payment of $23,242, and the loss of $5,000 allows you to pay $1,725 less in taxes. The ability to offset personal income tax with investment property losses is called negative gearing. However, these are actual rental losses that require out-of-pocket expenses. Yet considering depreciation as a non-cash loss, the tax refund could be even more significant. There might also be cases where the property does not incur actual rental losses but still qualifies for tax refund. This is why high-income earners in Australia particularly favor buying properties, especially new ones, due to high depreciation, allowing them to pay less personal income tax annually while benefiting from property value appreciation. Buying property is one of the few tax deductions methods for wage earners. The capital gain tax (CGT) concession means that if you buy an investment property and hold it for more than a year, for instance, making a profit of $5,000 upon sale, only 50% of that income, which is $2,500, is considered for personal income tax. In the example provided, you would only need to pay an additional $862.50 in taxes. The accuracy of these figures depends on when you're watching this video, as tax laws and rates change annually. Additionally, it's worth noting that while overseas individuals can utilize rental losses for deductions, they're ineligible for the CGT concession. Property investors rely on these two tax incentives to enhance their returns and make more money from real estate. It's often said that the rapid increase in property prices owes much to negative gearing and capital gains tax concessions. Imagine what would happen if they were abolished. As of the release of this video, the bill has not yet been passed. The Labour Party has repeatedly stated it would not consider abolishing these tax incentives. In the 2019 elections, the Labour Party insisted on scrapping these incentives but lost. In the 2022 elections, the Labour Party initially agreed with the Greens to abolish these incentives but abandoned the idea when it proved unpopular, leading to their election victory. Therefore, it's clear the Labour government supports the abolition but has compromised due to the political pressures, promising not to alter the incentives during the campaign. If you've been following this channel, you'd know that Labour government has already overturned two campaign promises: taxing superannuation accounts with balances over 3 million and third phase of tax cuts. Despite their current stance of no changes, I wouldn't be surprised if they eventually say we have no choices but to change. Once a government breaks trust, it's hard to consider it trustworthy again. The bill is still under debate in the parliament and a resolution expected soon. So will the government really pass a bill to abolish these two tax incentives? It's highly unlikely, and even if they do, by a slim chance, it wouldn't fundamentally shake the logic of property investment. Out of the 151 members of the parliament in Australia, 102, or two-thirds, own at least two properties, with at least 14 MPs own 4 or more properties, including the Prime Minister himself, with 3 properties. In other words, it's not an overstatement to say that the Australian federal government is composed of property investors. In other words, it's not an overstatement to say that the Australian federal government is composed of property investors. This is the deepest reason why the negative gearing policy hasn't changed in the past 40 years. Even if there are future changes, all policy directions will lean towards property investors. Even if there's a temporary setback, the corrective forces haven't weakened. Policy making fundamentally tilts towards the interests of property investors or the MPs themselves. According to the Australian Taxation Office, 2.4 million property investors benefit from the negative gearing policy. These 2.4 million people are not only a significant voter base, but also provide rental properties to the market. Offending these 2.4 million people does no good for the current government's re-election, nor does it help with actively solving the rental housing supply issue. The latest Australian unemployment rate has reached a new high in recent years at 4.1%, with interest rates remaining at a peak. With the economy in a downturn and unemployment rates rising, high loan interest rates suffocate many investors with a large amount of loans. Without negative gearing, those highly leveraged might have already collapsed. Changing tax laws now could lead to property sell-offs and a crash in housing prices. While it might be good for those who can't afford homes and cash-rich investors, it could cause social unrest. This is not good for the ruling party. If investors back out, it leaves only the government to address the rental issue. So it's highly likely that those two tax incentives will remain unchanged, but we can only wait to see the result. Oz Property Strategies Vision members often ask me this question during their first 90-minute strategy session after joining. Could Australia's current tax policies change? And if they do, would that make my investment return unpredictable? I'd like to address this question. Changes to Australians' future real estate investment-related taxation is inevitable. The only unknowns are when these changes will occur and what they will entail. For example, the negative gearing policy has been in place for 40 years and appears stable, yet it could still change in the future. My perspective is threefold. 1. The profitability of property investment isn't solely due to negative gearing, but through rental cash flow and property appreciation. All taxes should be considered part of the investment cost. As long as the net profit is positive and the return on investment, which is ROI, or more precisely, the cash-on-cash return, is favorable, then the essence of property investment hasn't changed. 2. All investments carry risks, including the possibility that money deposited in a bank might not be retrievable or the bank itself could fail. Risk stems from the amount of knowledge and experience you have. The same investment might seem risk-free to someone knowledgeable who knows how to control risks, whereas it appears entirely risky for you because you don't understand it. Therefore, you need to educate yourself or find a skilled team to manage your investment. there are no alternatives. 3. The only thing that is sure in today's world is nothing is for sure. No one knows the future. The best we can do is respond proactively when changes occur, or like Oz Property Strategy, provide Vision members with safety nets and market predictions based on extensive research to prepare for potential changes ahead of time. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. Have a good one. Bye-bye.